Bubbles happen, but if you're set up properly and you have things structured well, they don't matter so much. Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zegel.
Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
We've been hearing for many years now, lots of different concerns about bubbles happening in different areas. It could be a bubble in the market overall. It could be a bubble in AI investments. It could be a bubble in cryptocurrencies. It could be a bubble in gold and silver. Just keep the list going. Pick any bubble that has been talked about or listed for the past 15, 16 years since we hit the 08, 09, 2008, 2009 craziness and the Great Recession. There's been so many different little bubbles here and there. There's been concerns about bubbles in the overall valuation of the stock market, all this sorts of stuff. And sometimes, it's true that things were in a bubble and they did come down. What I will assert is if you have things structured properly, these bubbles really don't matter so much. And you should spend far less time worrying about what's a bubble, what's not, what valuation, this and that, blah, blah, blah. Think about this. Let's say you invested money at the worst possible time of the last couple of decades, which is in October of 2007, right before the stock market got crushed. We went into the Great Recession. We were worried about the financial structure that we have completely collapsing. October 2027. Terrible time to invest, right before the market downturn. Like, downturn is putting it lightly. It was pretty much a crash, a nice steady crash over the ensuing year or so. Let's say you invested money then. How would that have turned out for you? Consider this. From that point in October of 2007 till now, as of recording this here early in June of 2026, your compound annual growth rate on that money would have been 8.8%. You invested at arguably one of the worst times in history, and your long-term return just on the price, this is S&P 500, by the way, just on the price of the S&P 500 is 8.8%. That doesn't even include dividends. If you include dividends and reinvesting them, it comes to almost 11% by investing at arguably the worst time in history. Let that sink in. And let all the thoughts about different bubbles and everything else hopefully just vanish away. Maybe not right away, maybe slowly. Now, question is, how many would have held on during that decline? Not many. And I'm not arguing that you shouldn't make adjustments along the way. We talk about this all the time, where if we have a stock market that's going up, or certain investments that have gone up a lot, we will make adjustments. We will add another year or two onto our income. Remember, if this is your first time on the podcast, we talk about this all the time. But remember, we always want to have at least the next 5 years of our retirement income set aside and covered in individual bonds, CDs, something that is really safe, and they're going to mature throughout those 5 years to provide you that steady income. That way, when something goes wrong, because it will, when the stock market goes down or when certain investments go down, you have that set income and you can make little adjustments, but ideally continue to invest for the long term through that downturn. So let's back up to October of 2007. Let's say you have your 5 years of income, which you should. It took about 5 years for the market to recover and get back to the highs that we saw in October of 2007. So if you had your 5 years of income, you're able to invest for the long term and not go crazy. You can make some adjustments here and there, but you still would have gotten a tremendous benefit by holding on long term and by having at least 5 years of income for the market to bounce back. Now, ideally, we talked before about making adjustments. So ideally, as the market was going way up, which it had done really well going into the Great Recession, ideally, we would have made a little bit of an adjustment and added perhaps a 6th year, maybe even a 7th year, if we were feeling a little bit more conservative. But there was no need to completely freak out or really worry about what might happen or what might come. Because oftentimes what we see is people are so worried about this what if in the future that they fail to make the money along the way. And so now you failed to make money because you're so worried about the what if. And maybe that what if actually happens and everything goes down. And now you're dealing with this decline while you missed out on making money in the first place. So maybe the stock market doubles in the next several years and then hits a 50% decline. Well, you still had quite a nice gain, but a lot of people get so worried they don't actually make that double in the first place. And so they can say, well, yeah, we avoided this decline. Well, yeah, you also avoided the gain. So structure things properly is the message today, and worry less. Make sure you have at least the next 5 years of income set aside. If you're feeling extra conservative, go ahead and add a 6th year, maybe a 7th year. But don't spend a lot of time and energy worrying about the what if something else might happen. Make sure you have a good structure, and then you can focus on long term with the investments and less about what might be a bubble and what not. Focus on that structure, focus on tax planning, because that can save you a heck of a lot of money in the long term, and focus on your health. Do those three. Focus on structure, focus on tax planning, focus on health. You can make little adjustments along the way to the growth piece of the portfolio, but really that's the order: structure, tax planning, health. Not even that order. I'd put health first, but focus on those 3 items. And in the next video, we're going to talk about position sizing, which is also there for risk management, which will allow your investments to grow over the long term. But take care of your health, take care of your structure, take care of tax planning. Focus less on what might be a bubble or what might happen down the road. Worry less, enjoy life more, and definitely take care of your health.